Maersk bet $10 billion on methanol shipping in 2024. The world's second-largest container line ordered the industry's first large-scale green fuel fleet and promised carbon neutrality by 2040. Industry analysts praised the boldness, environmental groups celebrated. Yet today, those methanol vessels represent an existential threat. Fuel costs run 70% higher than conventional bunker fuel. Infrastructure exists at barely a dozen major ports. Ships designed for competitive advantage now operate at a severe disadvantage. Routes are constrained, while rivals sail cheaper and faster on fossil fuels. 4 years after the first orders, the green premium has become a death spiral. What invisible forces turned environmental leadership into corporate crisis? This is the trap reshaping maritime economics, and the lessons will haunt green technology investments across every industry. For decades after World War II, shipping operated on predictable economics. Container vessels moved 90% of global trade, powered by bunker fuel that was cheap and available at 5,000 ports worldwide. Maersk, founded in 1904, grew into the world's largest container line by mastering this stable system. Over 700 vessels, representing 17% of global capacity, produced profits from volume and efficiency, not from innovation bets. The business was boring and reliable. Engineers focused on incremental improvements, squeezing another percentage point of fuel efficiency. Industry culture was conservative by necessity. A single container ship represented hundreds of millions with operational lifespans measured in decades. No one bet on unproven technology. For Maersk's executives, this was identity. Shipping meant reliability, not headlines. Vessels were workhorses, not showpieces. But environmental regulators were no longer content to let shipping remain invisible. In 2018, the International Maritime Organization set targets that would fundamentally alter shipping economics. It called for a 50% emissions reduction by 2050, with 40% cuts required by 2030. The 2020 sulfur cap proved the IMO was serious. Fuel costs spiked. By 2023, net zero by 2050 became mandatory. Maersk surveyed alternatives. LNG suffered methane slip. Hydrogen required non-existent infrastructure. Ammonia carried toxicity risks. Methanol emerged as the seemingly rational choice. The fuel could be produced renewably, burned cleaner, and engine manufacturers had working prototypes. In 2021, Maersk ordered the industry's first large-scale methanol fleet and pledged carbon neutrality by 2040. Industry press responded with cautious optimism. Early estimates suggested methanol would cost 15% to 25% more than conventional fuel, a premium Maersk believed customers would accept. The path was chosen, orders were placed. The engineering challenges would prove far more expensive than anyone anticipated. Methanol dual-fuel engines require fundamentally different engineering. The fuel is corrosive, attacking standard alloys. Every fuel line, pump, and injector needed stainless steel or exotic materials. Methanol contains half the energy density of bunker fuel. Ships needed fuel tanks nearly twice the size, volume coming at the expense of cargo or requiring lengthened hulls. The dual-fuel design demanded backup diesel systems, effectively 2 fuel systems in one ship. Construction costs exploded. Maersk's first methanol vessels, estimated at $175 million each, came in closer to $240 million. The premium reached 35% to 40%, double projections. Shipyards struggled with delays. Suppliers hesitated on warranties. Early operations confirmed fears. Fuel maintenance proved far more complex. Methanol absorbs water, requiring constant monitoring. By 2023, warranty claims mounted. One manufacturer reported injector failures at 5 times the diesel rate. The pattern echoed the Fichte disaster. Unproven technology rushed to market, breaking down faster than engineers could diagnose. Vessels built, costs sunk, the bet was hemorrhaging. By 2023, despite mounting costs, Maersk doubled down. The company ordered additional vessels, expanding the fleet from 12 to over 25. Executives framed it as a strategic necessity. Scale would drive down costs, and infrastructure would follow demand. The CEO described methanol as the only credible path to 2040 targets. Board meetings tied executive compensation to emissions milestones. Reversing course would mean admitting mistakes, writing off hundreds of millions of dollars, and abandoning public commitments. The machinery was locked into forward momentum. Competitors watched and waited. MSC continued ordering conventional vessels. CMA-CGM diversified. COSCO, state-backed, could afford patience. Western companies could not. Analysts flagged concerns. Deutsche Bank noted green methanol production remained under 5% of what Maersk required. One analyst asked during earnings how Maersk planned to operate where no bunkering existed. Management admitted ships would run on conventional methanol or backup diesel until infrastructure caught up. By the time the full fleet was contracted, Maersk had bet $10 billion that the world would build the needed infrastructure. It did not. Today, fewer than 20 ports worldwide offer methanol bunkering. Compare that to 5,000 for conventional fuel. Singapore has limited methanol. Rotterdam added facilities, but they face capacity constraints. Green methanol represents under 2% of global supply. Maersk sources conventional methanol, a fossil derivative. Emissions benefits evaporate. Environmental leadership collapses. In 2021, planning assumed methanol would cost 20 to 30% above bunker fuel. By 2024, spot prices averaged $650 to $750 per ton versus $400 to $500 per ton for conventional fuel. Long-term contracts proved difficult. Producers refused fixed prices. Maersk faced spot volatility, or contract prices locking in losses. Route planning depends entirely on fuel availability. Vessels detour for fuel. Transatlantic routes force backup diesel use, defeating the dual fuel purpose. Methanol is classified as hazardous. Insurance premiums increased. Bunkering takes longer, reducing utilization. A conventional ship operating Asia to Europe spends $2.1 million on fuel per round trip. Maersk's methanol vessels spend $3.4 million. Customers will not pay premiums. Every voyage hemorrhages cash. Every constrained route surrenders market share. Maersk's methanol fleet runs 45 to 60% higher operating costs. The fuel premium adds $400 million annually across 25 vessels. With maintenance and inefficiencies added, the penalty exceeds $500 million every year. The $10 billion capital burden adds another $400 to $500 million annually before containers load. The Marine Division reported declining margins in 2024. MSC's conventional fleet enjoys fuel costs 40% lower per container. On key routes, rivals undercut freight rates by 15 to 20% while maintaining margins. Container rates collapse 60 to 70% from peaks. Maersk's methanol vessels cannot compete. The company either prices to cover costs, guaranteeing empty slots, or matches competitors and absorbs losses. Analysts downgraded Maersk's debt. Moody's flagged servicing concerns. One specialist noted the cost structure resembles operating propeller planes in the jet age. The green premium proved a myth. In commoditized markets, containers move at the lowest cost. Customers choose price over principles. The methanol bet was a capital trap, billions sunk into assets that cannot generate returns. Maersk's $10 billion commitment cannot unwind without catastrophic write-downs. The fleet is split between aging conventional vessels and methanol ships at a structural disadvantage. First mover advantage became a trap. Public commitment to 2040 carbon neutrality makes reversal impossible without reputational devastation. MSC exploited constraints, ordering conventional vessels at costs 35% lower. MSC operates the largest fleet with fuel costs that allow aggressive pricing. CMA-CGM hedged, preserving flexibility. Maersk surrendered. COSCO, state-backed, expands conventional capacity while Maersk bleeds. Maersk's capacity share declined from 17.2% in 2022 to 16.4% by mid-2025. On Asia-Europe routes, load factors dropped below 85%, while MSC and CMA-CGM ran above 92%. Analysts estimate Maersk may impair $2 to $3 billion in vessel value. Such charges would devastate earnings. Merger speculation circulates. Maersk announced 2,300 job cuts in 2025, 8% of the maritime workforce. Engine manufacturers scaled back programs after other orders failed. Planned methanol facilities in Los Angeles, Hamburg, and Busan were shelved. Private equity retreated. Regional carriers abandoned methanol plans. Green technology now carries a stigma as a path to ruin. Several methanol vessels sit at anchor in Singapore, awaiting bookings that never come. Too expensive to operate, too constrained to compete, too new to scrap. They represent $10 billion, generating negative returns. Conventional vessels sail past daily, hulls full, fuel cheap everywhere. If the world's second largest carrier cannot make green fuel work despite massive investment, the path to zero emissions remains obscure. Infrastructure investors are scared off. The window for 2050 targets narrows while the industry retreats to polluting technology. The race is no longer to the bold. It is to those who waited and avoided the trap that promised leadership but delivered ruin.